Hello, hi everyone. Welcome to today's masterclass. So good morning, good afternoon, good evening, depending on where you are. Thanks for joining the session. And also thanks to Digital Frontiers for organizing this discussion on tokenization in financial services. Today we will hold a 1-hour session. We will start with the definition of tokenization. Then we will shift to what assets can be tokenized. And after that, we will be specifically focusing on tokenized deposits, stable coins, and central bank digital currencies. And also, of course, policy and regulatory considerations around these three products. So let's start with what tokenization is in the next slide. So basically at its core, tokenization is representing value digitally using DLT, distributed ledger technology. And one helpful way to frame this comes from the OECD, which describes tokenization in two distinct but related ways. In the first model, tokenization can mean the digital representation of real existing assets on DLT. In the second, it can mean the direct issuance of financial assets in tokenized form. So in the first model, we are talking about about assets that are already exist in the real world. These include, for example, equities, bonds, real estate, investment funds, or commodities. In this setup, the token lives on a blockchain, but the asset itself remains off-chain. And it continues to be governed by the existing legal frameworks, existing regulatory frameworks, etc. So, but economic rights such as like ownership, dividend entitlements, or claims on cash flows are linked to the token through legal arrangements, through contractual arrangements. So the key idea, the key point here is, so when the token is transferred, those rights move with it. So, and this could make the blockchain an efficient way to record and the transfer claims. And at the same time, the underlying asset remains anchored in the traditional financial system. So this approach basically doesn't require reinventing the entire financial system overnight. Instead, it allows the existing assets, institutions, existing market practices to be like gradually integrated into blockchain-based infrastructure. So the second model goes one step further. So here, financial instruments are created directly on the blockchain, on the DLT. So they exist entirely on chain with no pre-existing off-chain assets. So the blockchain itself becomes the primary system of record for issuance, for ownership, for transfer, etc. And rights, for example, ownership, cash flows, or coupon payments can be embedded directly into smart contracts. For example, a bond could be issued natively on a blockchain, on a DLT, and the smart contract embedded would automatically calculate interest and distribute, for example, coupon payments to the token holders on, predetermined, defined dates. And ownership transfers could settle almost instantly. And this could reduce the need for multiple intermediaries. So in the next slide, let's look at a little bit what assets can be tokenized in general. So in practice, tokenization has already been applied to a very wide range of assets. It's been already here. This includes traditional financial assets, real-world assets, and even certain types of intangible rights. And we are also seeing tokenized applied in areas like, carbon credits. Here, tokens can represent verified emissions reductions. Also, identity and credentials of customers are also being tokenized. There are like pilots on that in some countries. And in those cases, the tokenization of identity and tokenization of credentials, tokens can be used for customer onboarding, for customer identification and verification, and proof of qualifications for customer onboarding by financial institutions, by banks, etc. So a useful rule of thumb here is that if something can be owned, can be transferred or generate cash flows, then it can be represented by a token. It is a general principle. So that said, several key conditions really determines whether tokenization actually works in practice. So first of all, there needs to be a legal clarity around what the token represents. And the rights attached to token must be, enforceable. And in the financial sector, there are already different products that are tokenized. As I mentioned in the previous slide, these include equities, bonds, investment funds, structured products, money market funds, money market instruments, etc. For example, debt instruments can be tokenized in a way that automates, settlement and coupon payments. And equities fund units can be represented as tokens to enable fractional ownership which could be useful for small investors and which could be useful for financial inclusion. And we are also seeing tokenized forms of money, I can say, become part of this broader ecosystem. For example, tokenized deposits, stable coins, and central bank digital currencies. So these are also tokenized. And these instruments are especially important for the financial sector, and they can act as, settlement assets within the tokenized financial markets. So in the rest of this session, we will be focusing primarily on tokenized deposits, stable coins, and CBDCs. And in the next slide, we will shift to tokenized deposits. So tokenized deposits have recently become a central topic in the policy discussions, that's for sure. And, central banks, the regulators, the financial authorities now discussing around the globe, discussing the tokenized deposits. And they are part of the broader debate about the, future of money, payments, and settlement in tokenized financial markets. And at the basic level, a tokenized deposit is a digital representation of a commercial bank, a bank deposit recorded on a DLT on a blockchain. So basically, it's denominated in fiat currency and represents a claim on a bank's balance sheet. So in this model, the token is issued 1-for-1 against deposits on the commercial bank's balance sheet. So while a tokenized deposit basically mirrors a traditional deposit, using DLT, distributed ledger technology, introduces new considerations. And these relate to how deposits are issued, how deposits are, tokenized deposits are transferred, held, and settled. And some of these features, especially technological features, may not always fit neatly within the existing regulatory frameworks. But from an infrastructure perspective, tokenized deposits are mainly being developed as settlement assets for tokenized markets in wholesale and institutional settings. This is one of the use cases. And they can support features like, atomic delivery versus payment. So basically where assets like, delivery and payment happen simultaneously on DLT. And they could enable real-time settlement. Tokenized deposits can also support, smart contract based programmability, and smart contracts can embed payment logic directly into transactions. So as an example, so funds can be automatically released only after some conditions are met. For example, successful asset transfer, compliance check, or settlement instructions. So now around the globe, there are several pilots and initiatives on tokenized deposits. And looking at the private sector initiatives, several global banks that you already know have already piloted or launched tokenized deposit solutions. And a well-known example is JP Morgan's JPM coin. So basically, JPM coin is a digital deposit token representing the USD deposit at the bank. And it has been rolled for institutional clients on Base, which is Coinbase's blockchain network. And this allows institutional customers, the JPM coin, allows institutional customers to send and receive tokenized USD deposits with near instant 24 settlement on a public blockchain. In parallel, also, some jurisdictions are running multi-bank or public-private pilots, by the way. For example, in Singapore, market participants have tested tokenized deposits with alongside tokenized deposits and tokenized funds. So basically, the goal was to enable end-to-end chain settlement, on-chain settlement. From a policy standpoint, these experiments are particularly interesting because they explore whether tokenized deposits can serve as a settlement asset while remaining under regulatory supervisory oversight. So this actually brings us to the regulatory landscape in general, which is still evolving. So the jury is it's still evolving, and in some jurisdictions, the financial authorities consider tokenized deposits to fall within the existing legal definition of a bank deposit, regardless of the technology used. Under this approach, I can say existing banking, existing prudential and deposit protection, deposit insurance rules apply. The main focus, I can say, is on ensuring that new technology does not undermine the established safeguards. And of course, in some countries, that's normal. Policymakers and the regulators are still assessing whether current existing frameworks embedded in the banking regulation, prudential regulations are sufficient. Questions around DLT governance, operational resilience, settlement finality, and questions around interoperability with other payment systems, traditional payments are generally part of the discussion. And in some cases, this already has led to consideration of additional guidance from the authorities. Maybe in the next slide, let me give a couple of examples on how countries approach to the regulation of tokenized deposits. So in the UK, United Kingdom, regulators have taken a largely technology neutral approach. So the core principle is straightforward. So basically, if an instrument meets the legal definition of a bank deposit, then it should be regulated as a deposit. So this applies regardless of whether it sits on a traditional ledger or it sits on a DLT. And tokenized deposits are already considered to sit within the existing banking framework. And this position actually was made very explicit in a letter from the UK's UK's Prudential Regulation Authority in 2023. The PRA, Prudential Regulatory Authority, confirmed that the issuing tokenized deposits is covered under a bank's existing license, as part of the regulated activity of accepting deposits. So basically, the tokenized deposits are subject to the same prudential requirements as traditional deposits. They must also meet the eligibility criteria for deposit protection, deposit introduction, deposit insurance under the UK's financial services compensation scheme. But at the same time, the regulators emphasize that new technology brings new risks, and the PRA highlighted that where tokenized deposit is offered, banks might need to adjust their approaches in areas, for example, in like AML/CFT controls, senior management accountability, and the calibration of liquidity, funding, and operational risk models. And in Singapore, as I mentioned, the Monetary Authority of Singapore, the regulator, acknowledged that the tokenized deposits may fall within the, again, existing definitions of deposits. But Monetary Authority of Singapore also actively supported the industry pilots to better understand how these, instruments work in practice. So I can say, rather than relying only on existing rules, Singapore used regulatory sandboxes and supervised, pilots. Basically, these structures have been used to test tokenized deposits, particularly in multi-bank settings and cross-border settings. So basically, the Master Supervisory Authority, the regulatory authority, try to understand whether additional guidance, whether additional safeguards might be needed as these models scale. In the European Union, so far the focus has been on classification and clear boundary setting. When I say this, policymakers emphasize the importance of distinguishing, making a distinction between the tokenized deposits issued by banks from crypto assets such as stable coins, which fall under separate regulatory regimes, which is called MiCA. The European Banking Authority also published a report, a separate report on tokenized deposits. This EBA report maps existing use cases on tokenized deposits, and the report assesses benefits and challenges, and it identifies potential supervisory responses. And similarly to the UK approach, one key conclusion is that recording a deposit claim on DLT does not change its legal nature as a deposit. So basically, if a tokenized deposit falls under the definition of deposit in the regulation, it should be considered as deposit. So basically, in line with the European Union's technology neutral approach, tokenized deposits remain subject to existing banking and deposit taking regulations. And at the same time, the report highlights that ongoing development in this area actually requires Varent's continued regulatory and supervisory attention, as the EU banking and the payment sector, continues to digitalize. So this was basically about the tokenized deposits, and maybe we can shift to the next slide to discuss more about the stable coins. I'm sure you already heard a lot about the stable coins, and stable coins have gone increasing the adoption globally, triggered by different factors in each region, in each country. And stable coins is another form of tokenization. So as a general definition, stable coins are, we can say, cryptocurrencies designed to maintain a stable value. Stable coins can be pegged to, for example, a currency, can be pegged to a basket of currencies, and can be pegged to commodities. And in many countries, consumers use stable coins. We are seeing the strong traction in emerging markets and developing economies, where stable coins address some pain points like volatile currencies, volatile domestic currencies, high cost, expensive remittances, and limited access to financial services. For example, individuals use stable coins for cross-border payments, cross-border remittances, but there are some considerations and issues around that. We will come to that issue in a minute. But also, I want to highlight that in high inflation economies, individuals, consumers use stable coins as a store of value, as a more stable alternative, I can say, to local currencies. So basically, it's, as you know, it's already happening in Venezuela, it's happening in Lebanon, Nigeria, Turkey. And also, stable coins give NGOs a way to deliver humanitarian aid quickly. So with full transparency and traceability. So stable coins are especially valuable in crisis zones, in war zones, where I can say banking infrastructure is limited or banking infrastructure is unreliable. And stable coins may also allow merchants and consumers to benefit from lower transaction costs, faster settlement, and also global reach, like, cross-border purposes. And as I said, adoption is rising in emerging markets and developing economies. And stable coins are also used for treasury and liquidity management. Stable coins basically give corporations a way to move, money instantly across borders and between business units without relying on banking cutoff times. So because I say that because the stable coins settle in real time and operate 24/7, and it gives the chance to companies to manage liquidity more efficiently. So another use case is the correspondent banking alternative. Stable coins may offer banks like a faster, lower cost alternative to traditional correspondent banking, and they may remove the need for intermediaries. And also another use case is government to person payments. So I'm saying that the governments are also exploring stable coins to improve transparency, to improve programmability, and traceability in G2P disbursement, government to person payments. So in the next slide, we will, before actually progressing, continuing the slides on stablecoins, maybe I should stop here and let me ask about your observation and experience from your jurisdiction. So basically, countries are at different stages of regulating stablecoins. Some countries are still exploring how to regulate stablecoins, as you know, but some other jurisdictions have already introduced regulatory frameworks. So basically, my question is, based on your experience, what key regulatory issues around stablecoins are emerging in your jurisdiction, in your country? So please feel free to weigh in. You can, unmute your mic and you can talk.
Hello, hi, can you hear me?
Yes.
Hi, my name is Woodyer Guthrie. I'm currently working here in Zurich, Switzerland, but I've been covering MiCA and the regulations, the upcoming regulations in the UK on stablecoin. So I found a very interesting point that you mentioned. I've also put it in the chat. You mentioned that the stablecoin could be linked to a basket, but the regulations with MiCA and also the Genius Act, it's usually the stablecoin is usually pegged to one currency. So how would it actually work if it's linked to a basket of currencies, and what currencies would be in that basket? And if it's possible to have a basket, how are these currencies linked on a one-to-one? How is it pegged to a one-to-one with a stablecoin?
Thanks for the question. Actually, we will come to that, the regulatory and policy considerations, including MiCA and Genius Act in a minute.
Yeah.
But in the evolving stable coins environment, now as you said, we are mainly seeing the stable coins pegged to the single currency and basically mostly USD1. So, and where the stable coins is pegged to the single currency, the reserves backing the stable coins should be maintained in this currency. But MiCA, again, we will come to that in a minute, but MiCA also allows the stablecoin issuers to issue stable coins in multiple currencies. Like, I don't know, you can do a basket like pack to USD, Euro, Singaporean dollar, or some other currencies. And the reserves should also be backing these stable coins accordingly, with diversifying the reserves. That's the one that is allowed. But when it comes to Genius Act, so again, we will come to that in a minute. At this point, it doesn't seem, from the act itself, it doesn't seem like the stable coin that is packed to multiple currencies or different baskets of currencies is allowed. So, and also in many countries, the regulators started with regulating stable coins packed to one single currency. So this is pretty much the case in many countries. So UK is also started to, maybe if you know more about the UK, structure.
The stablecoin, I'm looking at the draft regulations at the moment for for the UK stablecoin, and it's one-to-one. It's a one-to-one with only the sterling, with the Great British Pound. So it's quite interesting you mentioned the basket, because we'd like to know like in which countries are using like the basket, and what sort of regulations are they following if they're like using a basket, and if it's a one-to-one. And also, I've observed with on a separate point, I've noticed with the pending regulations in the UK that they have a systemic stablecoin
Yes.
that they want to put in place, but in the EU MiCA regulations and in the Genius Act in the US, there is no systemic stablecoin. And in the US Genius Act, they're waiting until the stablecoin generates up to 10 billion to have it as an established stablecoin, which I find very contrary to how the UK will be doing it.
So about that, thanks for sharing. About that, again, we will come to that in a minute. Maybe we can continue, then we can come back to the MiCA discussion, MiCA and Genius Act discussion. But on the MiCA side, there is also a significant, the significant issues. So basically, MiCA makes a distinction between the regular stablecoin issues and significant issues of significant stablecoins. So there's a definition of the significant in that case, and significant. So basically, again, I will be coming to that. But significant stablecoin issues and issues of the significant stablecoins are also subject to stricter rules and regulations compared to the regular stablecoin issues.
Okay.
So is there anyone who wants to contribute about their jurisdiction's stablecoin regulations or discussions on the stablecoin regulations?
Hi, Mehmet. There is one comment from Giselle Kinney. Hello, here in the Central Bank of the West African countries, we just started exploring. Can we say that stablecoins are similar to e-money, but used with blockchain technology and decentralized finance? Then I saw a hand from someone. Could you raise your hand again? And then I will thank you.
I don't see a hand raised right now.
Yeah, hello.
Hi, Hayford. Please go ahead.
Yeah, so my name is Hayford, and I work with the Bank of Ghana. So Ghana issued what we call the Virtual Asset Service Providers bill.
And congrats on that.
Thank you. It's been signed by the president, so it's now an act as of December last year, and we are commencing licensing processes. One question on our mind, because you're asking what are the key regulatory issues. As regulators, one question on our mind is, with these stable coins being pegged to currencies other than our own, of course, we may be having some ecosystem players who may develop some in the near future, but currently we have individuals, companies in Ghana who may be holding these stable coins, or who would now have the confidence to hold stable coins which are pegged to currencies other than our own. So what are the monetary policy implications for a country where you have significant numbers of people investing in stable or holding stable coins that is not pegged to your national currency? If you can share some thoughts on that.
That's a great question. Actually, in 3 slides, I will also come to that because yes, we are all talking about the opportunities around stable coins, but there is also risks when it comes to stable coins, including the what if they become like systemically important. So maybe let's continue to the next slide so we can also discuss the how e-money product has some stable coins has similarities with the e-money product. So when we come to the details of the evolving regulation, first of all, the definition of stable coins is important. For example, as we discussed, whether it may be packed to single currency or multiple currencies or other assets. And also, we are very familiar with the other financial service provider regulations. There are rules around who can be the issuers of the stable coin and what are the licensing conditions. And another important regulatory topics for stable coins is what are the rules around fund safeguarding and fund segregation to protect reserves backing customer funds, and how should the reserves be maintained? Also, what are the required composition of reserve assets? And also in the evolving stablecoin regulations, there is often a provision that the user of stablecoin cannot earn interest on stablecoins. And this is basically to make sure that the stablecoin issuance is not like deposit taking. And when it comes to consumer protection rules in the stablecoin regulations, the details differ. For example, MiCA, EU's regulation is extremely detailed about consumer protection rules, disclosure rules, transparency rules, complaints handling, and protection of customer funds, etc. And when it comes to AML-CFT rules, anti-money laundering and countering financing of terrorism rules, actually, in most stablecoin regulation, there is not that much detailed rules around AML-CFT. However, I need to mention that these stablecoin regulations, including the UK's draft, refers to the already existing AML-CFT laws and regulations, basically to make sure that coin issuers are also subject to these AML-CFT regulations. So basically, AML in general, AML-CFT laws define reporting entities. And reporting entities are like, as you know, banks, financial institutions, payment service providers, etc. So, and stablecoin regulations also make sure that stablecoins are considered as reporting entity in line with the AML-CFT regulations. So in the next slide, we will be coming to MiCA versus Genius Act. So we already mentioned some of the stuff, but so basically there are already some similarities and differences. EU's MiCA regulations allows the issuance of e-money tokens and asset reference tokens. So basically, both e-money tokens and asset reference tokens are stable coins. And e-money tokens can only be packed to one single fiat currency. On the other hand, asset reference tokens are packed to multiple fiat currencies. And according to MiCA, an e-money issuer or a bank can issue e-money tokens. So basically, e-money tokens or single currency packed stable coins are very similar to e-money, electronic money. That's why they are being regulated very similarly by the EU and for many countries. So basically, when you look at, I'm not saying the same regulations, by the way, I want to be very careful as also myself working on policy and the regulations. So e-money regulations and one-to-one packed, one-to-one fiat currency stable coins regulations are similar to each other and converging each other because the models are actually similar to each other. So that's why we are also talking about, for example, reserve assets. So for example, in both Genius Act of the US and MiCA of the EU, stablecoin issuers, for example, must maintain one-to-one reserve assets in high quality liquid assets, including bank deposits and government bills, etc. And this is also a little bit similar to do fund safeguarding regulations on the electronic money in many countries. And when it comes to the requirements on the composition of reserve assets, they are a little bit different. So Genius Act also lists the potential assets that is considered as high quality liquid assets. So regarding e-money tokens, MiCA requires that at least 30% of received funds must be held in segregated accounts with an EU bank. When it comes to transparency of reserves, reserve composition is highlighted in both regulations. So basically under the Genius Act, there is mandatory monthly public disclosure requirements for reserves. So basically there should also be regular independent audit on reserves. Under MiCA, the issuer needs to publish a white paper while issuing the stablecoins as a cert, and the issuer needs to keep it updated if there is material changes. And also, as I mentioned, in the EU side, there's a distinction between, for example, e-money tokens and significant e-money tokens. And significant e-money tokens must have independent audit of reserves every 6 months. So about the distinction between e-money tokens and significant e-money tokens, there are criteria on how to determine an e-money token is significant or not. So, for example, depending on the number of token holders, depending on the market value, depending on token reserve size, and also depending on the level of cross-border usage, and also depending on the interconnectedness level with the financial system, which brings the systemically important discussion here. So what I'm saying is, while the UK is directly regulating the systemic stablecoin points, the systemic stablecoin issuers and systemic stablecoins, MiCA is also addressing the significant stablecoins or material stablecoin issuers in the market in the MiCA. So in the next slide, let's shift to the stablecoins again, but this time for the cross-border opportunities, cross-border remittances and related opportunities. And cross-border payments, cross-border remittances is one of the most important use cases, and which is already used by individuals in many countries. And I'm a consultant with CGAP, also housed at the World Bank. And on the CGAP side, I also work on stablecoins and its potential to enhance cross-border remittances. And this presentation is also partially based on CGAP's work on tokenization. And I'm saying that because on that side, on the CGAP side, we're also discussing the opportunities that stablecoins can bring to the cross-border remittances. As you know, first of all, the stablecoins allow people to send, receive money, and store money using only a mobile phone and internet connection. And this can be especially powerful for unbanked and underbanked, underserved individuals who may not have access to traditional financial services. And since stable coins operate 24/7, they also help bypass the limitations of banking hours. Also, it fills some of the gaps created by de-risking in certain remittance corridors. And also by reducing the number of intermediaries involved in a transfer, stable coins can also help lower transaction fees, and their peg to major currencies can reduce exposure to foreign exchange volatility. And also, since settlement happens directly on a shared ledger, providers may also have lower processing and reconciliation costs, and this may translate into lower prices for users. And this is now one of the most important discussions in many countries, whether stable coins already bringing some cost advantage for low income, but we don't have like sufficient data on this yet. Another potential benefit is increased transparency and traceability. Since DLT blockchains provide immutable, tamper-proof transaction records, they enhance auditability and they allow near real-time, tracking of payment status throughout the process. And this could increase trust by users. So another advantage is actually stable coins can increase market competition. So basically they can enable new entrants and new business models in remittances, reducing reliance on traditional correspondent banking networks. And it's expected that more competition can ultimately help drive down, reduce the costs and improve services for consumers. So these are basically the opportunities and the potentials. In the next slide, maybe we should, highlight the risks that could stemming from the stable coins. So I can say the first major area is interoperability. And so basically the current ecosystem is fragmented. So when I say fragmented, there are like multiple blockchains, multiple stable coins. I don't know, there are like different types of protocols. So this means that assets may not always move easily between platforms. And there are like cross-chain bridges. And when cross-chain bridges are used to connect networks, they may add extra technical complexity. But on the other hand, there is also a risk of becoming locked into a specific blockchain or locked into a specific vendor. So this basically can limit the flexibility for providers as the ecosystem is evolving. And also another consideration is around the regulation and compliance. Regulations are, as you know, still evolving, and countries are basically taking different approaches. And basically they create inconsistencies across jurisdiction. But on the other hand, as you know, the crypto is borderless. So this is one of the most important considerations. And for cross-border payments, actually this may matter because providers, issuers have to comply with multiple rules at once. And, the requirements don't always align. And when it comes to, so basically in some countries, there are like capital controls or foreign exchange restrictions. This may limit the use of stable coins entirely, actually, because currently most stable coins are actually USD packed. And when it comes to the monetary policy, one of the main concerns is what will happen if one stable coin is becoming more important and more important in one market. So this means that, for example, let's say if the stable coins is packed to the US currency, USD, and in another country, I'm not talking about USA, and in that case, if the stable coin issuer, the systemic stable coin issuers USD packed stable coin and it's become more important, then it could impact the monetary policy of the central bank, and also it could impact the dollarization level in the domestic country where the currency is also weak. And another consideration is about compliance is the travel rule. So travel rule is related to AML-CFT, and it's coming from the Financial Action Task Force Recommendation 16. So basically, the travel rule requires sender and receiver information to accompany the crypto transfers, stablecoin transfers, but it's particularly complex on DLT, on decentralized platforms. And lastly, maybe I should also highlight that there is also some kind of operational and market risks stemming from the use of stablecoins. So as we mentioned, stablecoins ultimately rely on their issuers and the way those issuers manage their reserves. So if the governance is weak and if the level of transparency when it comes to the reserves is low, users, consumers can be exposed to counterparty risks. And we also have seen that during the periods of market stress, some stablecoins have already temporarily lost their peg, which could, disrupt the remittance flows if it were to happen at scale in a country, or globally. And also, as we mentioned, if there is a concentration risk, if users or providers depend too heavily on a single stable coin, any issue with that one asset can have, a big impact on the economy, domestic economy. So in the next slide, let me shift to the central bank digital currencies. We don't have that much time left, but so it's been discussed for some time, central bank of digital currencies. And when we talk about the central bank digital currencies, basically we are talking about a new form of fiat money. It's issued directly by central banks. So, and this is the difference actually. So because I'm saying that over the past decade, most of the innovation we have seen in payments and financial infrastructure has come from the private sector. For example, we talk about the e-money wallets, e-money issuers. There are crypto assets, stable coins, etc. But CBDCs are the public sector's, we can say, response to those developments. And most likely your country is already dealing or already researching or looking at central bank digital currencies. But CBDCs at a high level tend to fall into two broad categories. First, there are wholesale CBDCs and there are also retail CBDCs. So wholesale CBDCs are basically designed for the use by financial institutions, financial service providers, but retail CBDCs are basically intended for the general public. Regarding the retail CBDCs, let me mention that there are important design choices, and most central banks today are thinking about two-tier model. in this setup, basically the central bank issues the central bank digital currencies, but the financial sector, the private intermediaries, like banks or payment service providers, the e-money issuers, etc., handle distribution and customer onboarding and the user-facing services. Actually, in many countries, this is a deliberate policy choice by the central bank, because the central banks want to preserve the role of private sector in payments, while still giving the public access to the central bank money in a digital form. And if we zoom out globally, so over the past 5 years, momentum around CBDCs has accelerated very quickly, actually. So as of late 2025, more than 130 countries, and representing nearly 95% of the entire global economy are actually exploring CBDCs in some form. So back in 2020, it was just, a few dozen countries, but now we more than 130 countries dealing with that. And over 70 countries, jurisdictions are already in the advanced stages, including the pilots, even live developments. But I can say only a small number of countries, the Bahamas, Jamaica, and Nigeria, have fully launched retail CBDCs. But many countries are in the, I can say, exploratory phases. Maybe finally, I need to mention that the research on the retail CBDC. So basically, some jurisdictions, some countries have slowed down or reconsidered their retail CBDC plans. And in some countries, the debate has, become more cautious. And they focus on whether a retail CBDC is truly necessary, and also focusing on what problem it would actually solve. And also some countries discusses whether they really need retail CBDC, considering they already have appropriate private sector payment solutions. For example, Central Bank of Kenya, Central Bank of the Philippines, and Central Bank of the South African Reserve Bank announced that they are not planning to adopt retail CBDC at this stage, because they already have, developed payment systems in the domestic country. So next slide, please. Maybe I should stop here. We're almost running out of time. So if any question, please, you can unmute yourself and we can, discuss. Or if you have any contribution, please feel free.
Hi, Mehmet. We have a few questions in the chat. There is a question from Hayford. Hi, Ghana issued a regulation covering virtual assets service providers, including stablecoins, in December 2025, and is just commencing licensing processes. What risks do stablecoins pegged to other currencies pose to financial stability?
Yes, yes, Hayford already mentioned that, and we already discussed partially. So especially if the stable coin is pegged to a non-domestic currency, and if the stable coin becomes bigger and bigger in the market, yes, this is a concern for the financial stability that the supervisors and regulators needs to, monitor. This is one of the concerns. And also, by the way, that said, this is also a concern in Europe. I'm based in Germany, and I'm also following the developments on the digital euro and stablecoin discussion and MiCA here. So this is also one of the discussions in the EU. The discussion is what happens to the financial stability and the economy here in the EU if a stablecoin issuer or the private provider solution becomes systemically important. So that's why it's one of the reasons that the ECB, European Central Bank, is also working on retail CBDC, which is digital euro. So basically, the ECB wants to maintain the monetary sovereignty, and also they want to make sure that the individuals, people also can also access public money. So, and why digital euro will be an option for individuals. It's now being discussed. It's not live yet.
Okay, great. Then there's another question from Simon Peter Katongole. Apologies if I have butchered your surname. What is the difference between stable coins and Bitcoins?
That's a great question, because it's important. I'm saying that because of the discussions on the Bitcoin side and other cryptocurrencies, and because of the news we see that, or because of the volatility in prices of Bitcoin, there is some kind of tendency that crypto assets are like totally bad or total scam or something like that. But first of all, I need to mention that not all crypto assets are created equal. So there are differences. So basically, Bitcoin, in the Bitcoin, yes, it's a cryptocurrency, it's a crypto asset. But for example, there is no reserves backing the Bitcoin, for example. And if the consumer has an issue with the Bitcoin, for example, there is no place for the consumer to submit a complaint. There is no, dispute mechanisms for the Bitcoins. So basically, it's not really a regulated product. On the other hand, stable coins, also I need to mention that stable coins are not created equal. There are different types of stable coins. And if the stable coins is regulated and it's pegged to, for example, single currency or multiple currencies, and also if the stable coin is backed by reserves within a bank, for example, or by investing in some kind of liquid assets, then there are some regulatory safeguards regarding the stable coin. And most of the time, if there is a problem, for example, that the consumer experiences, the consumer knows that where they should go to submit a complaint or to solve the problem. So this is one of the most important differences. And stable coins is intended to be stable. So since it's pegged to a basket of assets, or it's pegged to a single currency or multiple currencies. But Bitcoin is not. And it's really volatile, as you are aware. So,
hello, I have another question.
Please go ahead, Odia.
Hi. Yeah, I have a question about the use of stablecoin in corporate treasury, and how do you foresee the stablecoin working with tokenized money market funds in corporate treasury?
Yes, thank you. And this is also discussed in the space right now. So whether stable coins can act as as like a settlement asset, because it's available 24/7, and and the corporates can access these products without any banking hour limits. So there is a potential there for the corporations to manage their treasury, treasury operations and liquidity management. And in parallel to that, there is also discussion about whether tokenized deposit can also cover that concern.
Yeah.
I'm saying that because tokenized deposit is also intended to be available 24/7 in the public blockchain in DLT. So whether there's also discussion that whether tokenized deposits can also be used by the corporations, to manage these liquidity issues of theirs. And actually, that's why JP Morgan's pilot, it's not a pilot anymore, by the way, sorry, JP Morgan's initiative or JPM coin is important because it's basically for institutional case and to understand whether it's useful for corporations.
Okay, I have one final question, and it's about the last point you mentioned about the CBDC in Jamaica, Nigeria, and Bahamas. You said that they've already launched it. Is there like a progress report to see how these emerging markets are dealing with like CBDC transactions?
Thanks for this question, Audio. Actually, this is a great question because when we look at the launch, the markets where the retail CBDC is launched. So, for example, Nigeria, Bahamas, and Jamaica. Actually, the adoption is very slow. So, and there are like, for example, especially for Nigeria, and IMF also recently published a report on that. So e-Naira, the adoption on e-Naira is really slow. And also, I'm not talking about the Nigeria in specific, but in general, for example, in Sub-Saharan Africa, there are 19 countries. The number of e-money accounts is bigger than the number of bank accounts. So I'm saying that e-money is also being adopted in many countries, like largely. And we know that in some countries in the Sub-Saharan Africa, for example, e-money is being used by individuals as it's their part of their lives. So especially in these countries, this has been discussed that whether retail CBDC is really needed, considering the e-money is there and it's actually solving partially solving the issues around access and solving the access problem partially. And considering the retail CBDC has some similarities between other payment solutions, private payment solutions, this has been discussed whether retail CBDC is really needed. And the Central Bank of Kenya actually is a great example. So basically in the last report on CBDC, they just mentioned that the Central Bank of Kenya, considering the existing payment solutions in the market, including the e-money, at this stage, they are not planning to adopt retail CBDC. Of course, they will be monitoring the situation in other countries, but they are not planning to adopt retail CBDC anytime soon. So basically, at the end of the day, it depends on what problems the retail CBDC would solve in the country, and it really depends on the country's situation.
So do you see a conflict with, say, the use of stablecoins and CBDC within like different nations? Because it seems like the stablecoin is a stronger option.
Are we comparing the stablecoin versus CBDC or stablecoin versus e-money?
Oh, the stablecoin and the CBDC issued by sovereign states.
So, and actually, so far, what we have been stablecoin in many countries also used for cross-border remittances. But of course, some countries also looking at how they can use CBDC for cross-border, but so far on the cross-border CBDC side, we have limited progress. There are like some pilots, there are some projects like Enbridge, etc. But stablecoins already actually enable individuals to use it for cross-border remittances. But I want to be very careful about saying that we need to look at, and especially the financial inclusion space need to look at whether stable coins has the cost advantage compared to existing current payment provider solutions that we use for wire transfers and cross-border transfers. Thank you.
Thank you very much. Yes,
thank you, Audio.
No problem.
Thanks all for joining today. I think we need to wrap up. So let me give the floor to Brenna to, close the session. Thanks all for joining.
Thank you everyone for joining us. We will share the presentation and you will receive early access to the masterclass recording as well. Thank you.